This video is brought to you by Brazil Resources, trading on the TSX Venture Exchange under the symbol BRI, and on the OTCQX International Market under BRIZF. Brazil Resources just announced an agreement to acquire 100% of the Cachoeira project from Luna Gold Corp. The deal terms imply BRI is paying $18 an ounce for gold in an emerging gold district in northern Brazil, located near BRI's other 3 gold projects. The company is 35% institutionally owned, with 16% of outstanding shares held by the KCR fund, controlled by Doug Casey, Rick Rule, and Marin Katusa. The geological team has earlier discovered more than 10 million ounces of gold directly in Brazil, and is led by successful mining CEO Amir Adnani. To learn more about Brazil Resources, visit BrazilResources.com or call 855-630-1001. I'm here with Dr. Steve Sjuggerud. I have to disclose, I've become somewhat of a Porter Stansberry Research, StansberryResearch.com junkie these last few months. Somebody introduced me to the site about 3 months ago. I knew of it, but I had never subscribed, and I'm a recent subscriber of True Wealth and Extreme Value and Retirement Millionaire. I'm just loving it, so I'm very happy to speak to you today.
Yeah, nice to meet you, yeah.
Sir, okay, so you just did a speech and you talked about Dow 50,000, stocks going really high, but at the same point in time, you're with Porter over there, who's got the End of America advertisement. So what's up with that?
Yeah, I mean, it's been fun, actually, a little banter back and forth, but the way we've resolved it is that yes, stocks will soar over the next couple years, and yes, the end of America is inevitable in the sense of Porter's description that we'll be spending so much money, we'll be borrowing so much money that we can't help but have a currency crisis in the States. And so these ideas of mine that stocks can soar and real estate prices can soar, and that we have a inevitable bad time ahead in the States, they're not competing concepts. The way that the U.S. is trying to prevent any kind of trouble is by pushing interest rates down to zero and doing everything they can, Ben Bernanke in particular. So I've called it the Bernanke asset bubble is my term for it. And with interest rates at zero, mom and pop America have to do something with their money. And you can't make any money in the bank, you can't make any money in bonds. To me, that money's going into stocks and real estate. So
now, what about the generation behind the baby boomers? They're not seeing the jobs that their parents saw. Many of them are unemployed. Many of them are getting $10 an hour jobs. There won't be that flow of money to come and support the baby boomers. Are you thinking that this is all going to be the baby boomers that are going to help drive this forward?
I think for the most part, really, yeah. What it is I would say for the last few years, the baby boomers generation has just held and hoped on earning next to nothing in interest. A few years ago, they might have earned 4% and said, gee, this isn't the retirement that I had hoped I would get. And then they might have seen 2% interest. Wow, this is really going to be tough to live on. Maybe times will get better. But now with 0% interest for years, now they're finally in a position of, wow, we're really cutting down our retirement nest egg. We have to do something different. We have to make a change. So it's not the young investor. It's not the guy that bought the .com stocks speculating. It's really mom and pop America is what I call the baby boomer generation. They're the ones that are going to have to make a change if they're going to survive their retirement. So they're going to have to buy stocks. Now,
the economy is somewhat supported, or probably completely supported, by government spending. The interest rates are being suppressed by the Fed. At some point in time, this will end, as you're acknowledging. Do you think you'll have time to get out? I mean, or what's the ultimate goal of, okay, I gotta get rid of my real estate and stocks and get into what?
Yeah, no, I think it's a good question, and the timing of that question is really the big question between Porter and me. That's Porter Stansberry, who runs our group. And Porter thinks it's sooner than later. Porter thinks that you don't know the day it could happen, but it's all about confidence, and the day that people lose confidence is the day that it's over. You lose confidence in your banks, there's a run on the banks. It's just like we saw a little bit of in the 2008 financial crisis. I mean, there was a loss of confidence. But for me, I think it can last. Basically, the government can fake it much longer than you can imagine. That's my belief. Yeah. What I mean by that is Japan's a great example. Japan has twice the debt as America, and their interest rates are lower than the States. That seems crazy, doesn't it? And it's almost like Japan is 10 years ahead of the States in this whole process of deleveraging and the way that the Japanese government has been fighting their natural shrinking of the economy is by printing money and lowering interest rates. They're doing the same thing that we're doing, and there hasn't been the crash yet in Japan. And I'm not saying that we are going to be like Japan. I'm just saying that with Japan as an example, the government can fake it a lot longer than you can imagine. They can continue to buy treasury bonds and push interest rates down longer than is rational. They can continue to print money longer than is rational. That's what Japan has done, and they're way further down. Japan is almost hopeless, and I'm buying Japanese stocks. Think about that, because it's the same concept. You know, Japan is flooding the economy with money, the rates are low.
So are these things actually increasing in value, or are they just, is the measuring stick just getting bigger because of the devaluation?
What you just said to me, the question you just asked tells me that you get it. You get what's going on. And because what you're saying is the price of a house really going up in value? Is the price of a business, is the value of a stock, is it really going up? Or is it just that the inflation that the government is creating, is it manifesting itself through higher home prices and higher stock prices? And I think you're exactly right, actually, that the irony of the whole thing is that the government wants to help out the little guy. The government wants the little guy to buy a house and for the value of his house to go up so his net worth is positive again. The government is doing these things to help the little guy, but the reality is, who's buying stocks and who's buying real estate? It's not the little guy, it's the bigger investor. So when you create the inflation that you were just correctly nailing, the winner is the bigger guy whose net worth doesn't go down, and the loser is the little guy who couldn't participate in that, but his purchasing power went down. So, I mean, it's a technical question that you're asking at its core, but you're right. I mean, does my answer make sense to you?
Yeah, it does. You know, and it leads me to housing, at least the fear in housing. I've actually been buying houses, but smaller rental properties. But of course, in the back of my mind, there's a fear that in the Greater Depression, as Doug Casey calls it, the renters aren't going to be able to pay the rent. And this concerns me less because I'm not buying it for appreciation, but there is a concern for people that the housing is just going to collapse. Once interest rates go up, I mean, if they're barely moving now at the low interest rates now, what's going to happen when you have an 8 to 14% interest rate? I mean, does this concern you at all? I mean, should this concern people?
Yeah, I think it's much further away. This is my own personal opinion. I can completely be wrong, but I think the day that you're worried about is much further away. And again, Japan is that example, buying 75% of I think they're essentially buying all of the issuance of government bonds in their country. They're forcing interest rates down, and they're keeping them there, and they've kept them there. I think it's really going to be difficult for rates. I think you'll have time. As I showed in my chart, once interest rates hit 5% in the past, in the 70s, each time interest rates hit 5% in the 70s, stock market went down. That might be your first indication of, hey, maybe it's time for me to start, lightening my load on some of these assets. But I think real estate is actually a great asset to be in because you are going to keep up with the purchase. The land value is going to go up, whereas your money in the bank is going to go down. It's going to lose purchasing power. And not only is your asset going up in value in dollar terms, but you're earning rent. You're getting a yield off of an asset that's going up in value. There aren't that many things that you can do that with, really. So it might be, your real estate property might be the least ugly participant in the beauty contest. And therefore it's the winner. It's not the prettiest, it's the least ugly, but that was out of all of the ugly choices that you had for a winner, you chose the right winner, but you just didn't have that many pretty ones to choose from.
So overall, your assessment is that we're kind of going to have basically a slow grind?
I think we're going to have a crazy boom in both stocks and in real estate that will last years. I mean, the Fed is clearly defined its targets where it wants to see inflation at a certain rate. It wants to see unemployment fall to a certain rate. And these rates we're not even near these levels. I think it'll be years before we hit those levels. And Bernanke, who will be outgoing, but Bernanke has always said that he is going to stimulate beyond the point of reason, essentially. I mean, he doesn't want us to be like the Great Depression. He doesn't want us to be like Japan. So he's not going to take the punch bowl away until it's beyond safe to do so. So I know you're a lot of your questions are getting at like, okay, well, when does the bad time happen, and how bad is it going to be? And I think that the right way to pursue it is how good could the good times be, and what should be my signal for when to move along. I mean, that's kind of what I was trying to share.
Yeah.
I don't know how bad the bad times can be, but I think you should concentrate on the good times, but knowing that the good times are essentially a fraud. They're a Bernanke created fraud, and so by knowing that and going in knowing that, you have no personal problem with selling a position. For example, in the dot-com boom, people fell in love with their stocks, and they thought that whatever it was, Qualcomm or Cisco, could do them no wrong. They fell in love with Cisco, but I hope you understand that my point here is that when you already know that it's built on sand, that you know that it can't go up forever, you know that it has to return to where it was, so you can have the confidence to sell before the next guy. In my newsletter, we use trailing stops, and I remember in the dot-com era, Porter Stansberry had bought a stock called JDS Uniphase, and he made like 1,000% gain on it using a 25% trailing stop. And there's no way that Porter would have predicted that the stock would go up 1,000% over 2 years or whatnot, but he rode the trend. And the story for JDS Uniphase kept getting better, and meanwhile the dot-com bubble was continuing to ride higher and higher. And when the stock fell 25% in February of 2000, we sold for 900% gain. I think was the ultimate, that's what we closed out at. It went up 1,200%, fell by 25%, and we took a 900% gain. My point, I guess, is that you want to ride it as long as you can, even when you know it's beyond reason. And then when you see it start to roll over, when you see the signs that you set out for yourself, or the stop losses that you set out for yourself, take those and move on, and don't lose. I mean, when we sold that, we didn't think twice about it. I mean, of course, we wanted more fun, but in February of 2000, I think we stopped out of most of the stocks that we had owned, and then the peak happened in March of 2000, and I don't remember the exact dates. Maybe it was right after March of 2000 that everything stopped out, and you didn't know at the time that the NASDAQ was going to fall from 5,000 to 1,500 or whatnot.
Yeah.
But all we knew was that we had to sell things that we were up 100% on, and they're now only up 75%, and we sold. And so that was a long answer, but that's what I mean by let it ride, and just be willing, without emotion, to take it off the table after you've enjoyed the ride.
In closing, where is the best place for someone to learn more about your newsletter and your work?
We have a free site, dailywealth.com, and honestly, if you ask where the best place to learn about our stuff, and I've been writing Daily Wealth for many years. We have archives there. You can learn how I think about a lot of different things. You're welcome to subscribe to True Wealth, and that's at stansberryresearch.com. But and that's inexpensive as well, less than $100 a year. But I think dailywealth.com is a great start for what I do. I mean, you get great content for free, and you can go through the archives and see my opinions on all kinds of investment topics under the sun, and see if I was right or wrong, and it's all there for you to see. So dailywealth.com is the best place.
And so Dow 50,000, can we bank on
that?
Well,
no, Dow 50,000, that was really just to cause Porter and Bill Bonner and Doug Casey to have a heart attack. But that wasn't something to bank on, but it was just a way to kind of wake people up and say, look, if based on current interest rates being so low in the States, fair value on stocks in the U.S. could be 50,000. That's only one measure, and it's so yeah. I don't mean to backpedal too much from it, but the point is that the upside in stocks is much higher than most people believe right now. I mean, I've been saying this for a long time now, and people are just starting to come around to, now that we've seen new highs in the stock market, people are coming around to my way of thinking. But I've been saying it for a while, and I still continue to believe that there's plenty of upside.
Does that scare you if too many people come around to your thinking?
It does, yeah. We're not there yet. I mean, Mom and Pop America are still on the sidelines, and I think we're going to end in a dot-com type bubble where Mom and Pop are fully invested in cocktail party chatter is all about whatever the big names are of the day a couple years from now. So
will this also include any resource stocks, or are they going to just be left for dead?
Yeah, no, it's a great question, and I've in my newsletter I've called it the script, and the script has been that mom and pop will first come into the market and they'll buy big name dividend stocks, Pfizer and Johnson & Johnson, and then they'll have some success, which they've had so far. I've called that Act 1. And then Act 2, they're buying big name tech stocks, Microsoft and Google and things they're comfortable with, and Apple, and we're just starting, like as we sit here talking, we're just starting to see that. I believe that this Act 2, as I call it, is just starting. And once they have some good success in that, then they'll be emboldened, and it'll be time for small cap stocks, resource stocks, emerging market stocks, the biggest risky stocks, the most risky stocks. And I think that those will be the biggest booming stocks. But I don't think we're quite to Act 3 yet. We're still in Act 2 where mom and pop are just starting. We're still in Act 1 where mom and pop are feeling the success of their dividend buys, and they're moving into slightly more risky names, but still big names. And then Act 3, which I don't have a time frame, but 6-9 months from now, we should start seeing them looking at speculative stocks, emerging markets, small caps, resource companies. And this is a very big picture thing. I mean, I don't have any resource names for you. It's not my specialty, and just this is kind of the script. And the script is who knows if the market will actually follow it, but it's just a little thesis, so you know where you are. And if I'm right, we're not quite there yet, but the fun should be awesome once we get there.
I really hope you're right.
Yeah, so.
I'm cheering for Bernanke too.
Yeah, okay, we're good.
Thanks so much.
Absolutely, yeah, my pleasure.
Yep.